Good morning and welcome to the Saxo Bank Morning Call. It is Monday, December 3rd, and we had quite a few developments over the weekend with this G20 summit and the Xi and Trump meeting. The development there, of course, was effectively a ceasefire, the best scenario we could hope for, as we outlined a bit last week. We didn't think any comprehensive deal would be in the making here, and that, of course, turned out to be the case. But there was an agreement to sort of de-escalate here and not move forward with those big new tariffs scheduled to go into effect on January 1st from the U.S.'s side, that bump up to the 25% level, and for an investigation into whether they can make progress on 5 key areas. And I've got that on a slide here, and this it's quite a menu. Before we get lose our minds and set our hair on fire in terms of going risk on here, there is a lot to accomplish here if we're going to see something more comprehensive develop. Forced technology transfer, intellectual property protection, non-tariff barriers, the cyber issues. I'm not sure what the services and agriculture bit is about, but clearly that's a long laundry list of things to make progress on. And then we saw, besides this Xi-Trump meeting itself, the G20 statement showing this interesting development where they're dropping the protectionism to sort of make friendly with the U.S. side, and then dropping the unfair trade practices language, which China felt was headed its way, and then agreeing that the entire WTO infrastructure needs to be resigned. I mean, clearly deglobalization is going on here, and these institutions, these so-called multilateral institutions, facing a fight for their lives, I fear, in coming years. So for now, the market is celebrating that. Peter, we have the equity market, off hours up almost 2% in some cases.
Yep.
I think the NASDAQ, you said, was over 2%.
Over 2% to almost 2.5%.
Yeah. I guess the key question is this going to last into the end of the year? Is this a one-off day, one-day affair? What's your take on this?
Well, my take on equities is that we sort of have 2 major hurdles that I argued in media would not make a Santa rally, and that was the Fed's current rate trajectory, and then also the G20 or the US-China crisis. And I think both G20 and the Fed sort of have delivered here. So I would not be surprised unless we see some headlines risk coming in from Trump changing his mind on this ceasefire. I think that the equity investors will be buying this. There's a lot of cash that wants to get into the arena again. If you take up the chart here, we have the S&P 500. That's probably good for perspective. So you can see here that I think
this is the cash, so we don't have that future reaction on this last bar here, but
so
it's close to that big line, that 2,800 plus line.
Yeah, but we will, when the market opens today, we will begin to test the highs from early November in the cash index, and let's see how far this momentum can carry us. I think the US index is a very narrow focus. If you look at the global equity market, I would not be surprised to see a 5-6% gain from here. But I agree with you. I mean, the deeper conflict between US and China really runs quite deep, so we could easily swing back into a negative mode.
And you talk about the Fed supporting the market. I think the market has a bit overinterpreted the Fed, and if all of these issues start to fade away and we see strong risk appetite, I think they're happy to deliver a message that says, look, we're continuing with our rate hikes from here. We'll know that, of course, not until we won't know that until that December 19th FOMC meeting. Ole, high fives all around from Putin and
yes.
the MBS at the G20, and we have a bit of an agreement here that's really boosted the oil price.
Yeah, the top performer today is crude oil. We're up nearly 5%, and it's a combination of several things. As you mentioned, John, we had a high five in Buenos Aires over the weekend, so that led the market to believe that OPEC, when they meet later this week on November 6th, will decide to curb production once again in order to support the price. So we have reacted accordingly, and I think what market most of all needed to say was psychological boost, because we really have been in a terrible downtrend now for a while. So I think this initially is a psychological boost. Now they need to deliver. We'll see that later in the week.
And we'll talk about soybeans a little bit later, but a bit of an underwhelming reaction there.
Yeah, I think so. The fact that in the statement from the White House, they said that China was going to open up for imports immediately, has really only taken us slightly above previous resistance. So clearly the market there's other things at play as well at this stage, but we'll look at that.
Yeah. And in China, of course, the Chinese side, the reaction there, it's worth noting we have equities. We have Peter supplied us with an equity chart here. Still hasn't really cleared resistance. So this is not exactly an overwhelming bounce we're seeing.
No, exactly. Yeah. As you can see here, we are bouncing towards that that ceiling here we have now been in for 3 times, and it looks like we're heading for a 4th time here. So that's the red line. It's 3,300 in the CSI 300, which is the mainland Chinese equity index covering Shanghai and the Shenzhen exchanges. And but I said on Twitter, based on what happened over the weekend, that I think you should be, tactically here short term, be overweight China, being overweight the cyclicals, even European equities, and look for also semiconductors. I think, of course, the reaction will be quite sizable in U.S. equities, but I think other parts of the world, so EM, China, and Europe, has been so much battered down that I think they will push back.
And a weaker dollar, if that's what we're seeing, the risk on it and the weaker dollar feed on each other, and that's going to that's going to really feed into these emerging market indices. We have back to the chart. We have the dollar CNY here. Of course, we saw a reaction there, and I think we can expect at least for the next 90 days to see this trading well below 7. The question is, does a proper trend develop, or is it just simply holding the line until we get to that end of that 90-day time frame? Ole?
And that's probably your explanation for as to why we see gold trading higher this morning, because you would imagine with all the risk on we have, with the reduced geopolitical risk, gold should suffer, but it has been tied to quite significant to the renminbi. So if we see that strengthen, then that could provide some support for gold as well.
And if we're looking for a single trade, at least within G10 currencies, that captures the weekend's development, I would argue we should have a look at dollar CAD. Got a chart here. I mean, we have the oil price bounce driving potentially some CAD strength there. We've seen a bigger reaction there than in some of the other currencies, and then as well the weaker dollar on global risk on here, and the Fed stepping away from its more hawkish line. So at least back towards the 131, 130 area. I'm really I think the main thing we're going to get in terms of reaction is dampened volatility. I mean, we can't really draw conclusions about where this is all headed within this 90-day time frame. I think maybe we have a rally into year end, but do we really have much beyond that until we know what this is going to look like beyond that 90-day time frame again? Finally, on the currency side, dollar MEX is interesting. We have Mr. Obrador finally taking charge in Mexico after that long period between the election and December 1st, when he takes power. A very dramatic speech over the weekend. What will his presidency look like? The fears about fiscal excess, the fears that he's some shade of a Hugo Chavez now come to power in Mexico with a very strong mandate, having both houses of the legislature there as well. That has fed some Mexican peso weakness, and I think it's very interesting to see how his presidency looks, and he's now hitting the ground here. For now, the market is rather supportive given this G20 backdrop. Ole, back to commodities. We have this. We've got a couple slides here on oil and some thoughts on where we're going from here.
Yeah. First of all, just as the first slide, I just give an idea about some of the movements we've seen so far today. The energy sector is clearly the one which is in front. Copper is reacting positively to the potential outlook for growth if the trade war risk is diminishing, so that's up as well. And then we have the soybeans down there, and you probably expected that to see that gain being more than just in the region of 2%. You look at the chart on the right. We see we've broken above $9 a bushel, but the problem with soybeans right now is that the window of opportunity is relatively short, because come January then we have a wall of supply coming from South America once again. So there's really only a few months left for them really to boost exports. So the question is how much can be achieved. So that's why the market is reacting relatively lukewarm to this perceived good news, and also actually the fact that the market is short. Speculators has been selling, so there has been some short covering as well. So I would expect a bigger move than what we've seen.
And then on oil, you have some thoughts. The positioning, first of all, is very interesting. That big speculative long is more or less unwound.
Absolutely. The announcement this weekend is coming at a very opportunistic good time. We've seen in the past, over the past couple of years, when the combined net long in WTI and Brent that's the yellow line, reached just around the 300,000 lot mark, then we've seen quite a strong reaction, the buyers returning, and that's exactly the level we reached last week. It's the weakest long in 3 years. So entering into this weekend's announcement from Saudi Arabia and Russia, oil is really receiving a bit of a boost. So if we can hold these levels now for the coming days, then we potentially could be looking at a bottom having been placed in the market. But if we just take a look at it, go back to the chart with the crude oil, you can see Brent could actually move all the way back up towards the 70 area. But I think what's also important over the weekend was that Alberta in Canada, which is a prolific production area, has ordered a production cut of more than 300,000 barrels a day. They have a big excess of supply, which they cannot get rid of because of transportation problems.
And the U.S. production continues.
And U.S. production rising at the same time. So the chart I was just showing there on the right basically show how much of a discount Canadian producers had to accept. And just back in a few months ago, they accepted a discount of almost $50 below WTI. I mean, you can't make money at that level. No. So they need to reduce the discount to WTI. They do that by ordering a production cut. So that's also providing some psychological boost to the market.
Sure. All right, let's round it off with the economics calendar slide for this for today and for the rest of the week. We've got a couple of Fed speakers, more than a couple, 3 on the Board of Governors out speaking. Watch out for that Clarida TV interview. I think that's one of the more interesting of those 3 appearances. We've had some back and forth from him of different, one that looked dovish, one that looked a little bit less dovish. So keep an eye on that. The ISM manufacturing as well this afternoon, as it is Global Manufacturing PMI Day. And then the Australian RBA out overnight. And to me, maybe it's a small thing, but one of the indicators that a lot of this reaction to G20 is a bit on the surface and not profound is if we look at the short rates in Australia, they've gone absolutely nowhere. There was about a 1 or 2 basis point reaction overnight. That was unwound. So the market not looking at this as providing any sort of longer term impulse into the rate outlook for Australia. So I don't think we'll see anything from the RBA. Bank of Canada out later this week. They're not expected to hike this time around. They are expected to hike in January if things are going as hoped for the economy. And then Friday will be the very interesting one. I think we have a really strong average hourly earnings print. It might, and we're seeing all this risk on and so on. I think it might set the markets on edge about its interpretation of how much the Fed has downshifted away from its more hawkish guidance. That's it for now. We'll be back tomorrow with the Saxo Bank Morning Call.